The ASX 200 plunged 7.3% in September, one of its worst months on record. So far, it's up about 3% in October, but the market is still pretty close to its lowest level since the end of 2020. So where does it go from here? Well, joining me now on the set is Perpetual's Head of Investment Strategy, Matt Sherwood, who recently won Zenith Investment Partners' Best Real Return Fund at the Zenith Awards. Matt, congratulations for that, but have markets really hit the bottom yet, or is there still a way to go?
Well, thanks for having me on the show, Ed, and it's a team award, so I didn't win it. It was the multi-asset team. But, my suspicion is the market's got more to fall. And it's certainly not the time for investors to go bottom fishing at the moment. And what we've had so far this year is global equities are off 25%, Australian equities are down by around 11%, but it's all been valuation contraction. Central banks have jacked up rates. Real bond yields have risen, that's weighed on PE ratios. But what the market hasn't factored in yet is the earnings destruction, which is likely to occur in 2023. And that, to me, is going to be another headwind for the market. So, we're not getting tempted at these levels just yet.
Are we talking first quarter next year or a bit later on in the year?
Well, our suspicion is the global recession occurs in the second half of next year. It's going to be driven by the US economy. Most of the regions will follow them down. Australia's soft landing prospects, are reasonable at this stage. The currency is doing the usual job at shock absorbing, and the echoes out of the RBA is that they probably only want to hike rates 3 more times, and then they will go on pause and have a look to see how the economy adjusts. So they seem to be leaning a bit more towards financial stability than just solely jacking rates up until you get a labour market correction like the Fed's doing. So that improves our outlook.
Yeah, Treasurer Jim Chalmers says our economy seems to be in better shape than others around the world. But what are some of the really big risks out there that are making investors nervous and sell off their shares?
Yeah, well, clearly the big risk at the moment is just the inflation backdrop and what that is forcing central banks to do. So what we've seen in the Fed is that in the last couple of months, they have put an increase in US unemployment right at the centre of their reaction function. So they're just going to continue to move rates up. And obviously that's the clear economic risk, is higher rates cause recession. But probably a tail risk, I think, is the Fed is not only increasing rates aggressively each meeting, but they're doing it just meeting after meeting. So this is the most aggressive tightening cycle pretty much since Volcker in the early 1980s. That could, if those tentacles go far enough, start to spark some financial dislocation and the sort of stresses that we've seen in other periods of financial crisis. So, it's just a tail risk at this stage. It's not a central case. But if inflation proves more resilient, the Fed's probably going to tighten more. And of course, the more they tighten, the more those risks in the dark areas of the financial system and the financial markets can actually be triggered and into a liquidity crisis. And where that goes from there, of course, depends on where the central bank goes. But that's just a risk case at this stage.
And how confident are you feeling as an investment strategist right now?
Well, I tend to think that we remain pretty cautious, and I do too. Recession next year not being priced as market is not really a reason to just dive in head first. Even when we started this year, we came in there thinking, US bond yields with a one handle in front of it when we got 40-year highs in inflation and 50-year lows or close to it in unemployment, really didn't kind of sit well with us. So we were very defensively positioned in our real return fund. We had no duration exposure, and we knew that if bond yields rose, that would be a pretty serious headwind also for equities. And we had a very low equity exposure, and we augmented that with a lot of put option protection. Now, we still remain pretty guarded and cautious. I think there are risks out there. This turns into a much bigger sell-off, and it really depends on what central banks do and how markets react to that. So there's certainly that possibility. So we're not dipping our toe in the water at the moment.
Cash rates are 2.6% in Australia right now. What's the money market pricing it in? Where's it going to get up to?
Yeah, this is an interesting one because the money markets have the RBA doing another 150 points within the next year, just to over 4%. Now, the worry I would have with an interest rate that high is that it takes it might actually just crack the housing market here. And the reason why that's a worry is particularly the bank's exposure to that housing market. Now, house prices have risen about 50% since the trough they had late last decade. So prices coming off 10% after 50%, is not really a big deal. But the real big key here is that if there's much more strain on the housing market and you get forced selling, all of a sudden you can have a much bigger price collapse, and that could trigger some stresses in the economy and also in the financial system. So again, not a base case, but it's certainly a risk that is out there.
Looking at America, according to BlackRock, it's just been the worst year of performance for stocks and bonds since 1969, apparently. I mean, what are the chances for the US economy being in a recession as we speak?
At the moment, I think they're pretty extremely low. There's still quite a bit of strength in the private economy, so consumption still remains fairly solid, and the labour market at this stage remains intact. But that said, we tend to think that a recession probability next year is around 70%. So it's very, very elevated. Normally, you might have a 10% probability for any random year. So, very elevated. That they've never had such high inflation without it leading to a recession. And of course, the Fed is hiking rates very, very aggressively. And in some ways, I almost think they're embracing their inner Volcker and engineering a recession because they probably know it's the only way to get inflation back to 2%, given the backdrop we have of up to 8 to 9% inflation with an unemployment rate at a 50-year low.
Well, Matt Sherwood, Head of Investment Strategy at Perpetual, thanks so much for your time today.
Thanks for having me, Ed, and all the best.